The Social Security Administration sent out roughly 68 million benefit payments last month. About a third of those people claimed before their full retirement age.
Most of them took the money at 62. And here's what none of them were told before they signed the paperwork.
The decision of when to claim Social Security is not actually a Social Security decision. It's a tax decision. And the people who figured that out, specifically the people who understood what happens in the years before they ever file, ended up with dramatically more money, paid dramatically less in taxes, and in many cases left their spouses with significantly more income after they were gone. The timing of your claim is the decoy. The tax architecture of your retirement income is the actual game. And I'm going to walk you through exactly how it works with real numbers so you can see why most people leave somewhere between $100,000 and $200,000 on the... Here's what this video actually is. It is not a debate about 62 versus 70. That debate exists everywhere. This is about a specific window of time, usually somewhere between 3 and 8 years wide, that opens up between when you retire and when you start your Social Security benefit, where you have a legal opportunity to restructure your entire tax situation in a way that compounds for the rest of your life. Miss the window and you don't get it back. The window closes the moment you press the button on the vending machine. And I'm going to explain what I mean by that, because the vending machine metaphor is going to follow us through this entire conversation, and it's going to earn its keep. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Okay, the vending machine. Imagine you spent 40 years feeding quarters into a machine. Every paycheck, every 2 weeks for your entire working life. Payroll taxes, FICA, the line on your stub that always felt like a slow leak. Now you're 62, you're standing in front of this machine, you're hungry. And the machine says, press the button now and get 70% of what you paid for. Or wait 8 years and get the whole thing, plus 24% on top of what you would have gotten at your full retirement age. Most people press the button, and the moment they do, the machine locks. That 70% becomes the permanent floor. Every future cost of living adjustment is calculated as a percentage of the locked-in number. Every inflation bump widens the gap between where you are and where you could have been. You're not behind by a fixed dollar amount. You're behind on a growing curve. Ha ha ha! The machine keeps dispensing. It just dispenses from a lower floor, forever. I want to give you a framework before we go any further, because Social Security decisions happen on 3 separate levels. And most people, and frankly, most of the internet content about this topic, only think about level 1. Level 1 is your own monthly benefit. How much you get, when you get it, and for how long. That's where the break-even calculators live. That's where the "will I live past 80" question lives. Level 2 is your household income specifically. How your claiming decision affects your spouse's situation both during your lifetime and after you're gone. This is where the biggest concentrations of lost money actually exist. And almost nobody talks about it in plain language. Level 3 is your tax architecture, the interaction between Social Security income, IRA withdrawals, capital gains, and Medicare premiums. The people who get retirement right operate on all 3 levels at once. The people who get hurt were only ever thinking about level 1. I want to start with level 2 because it's the second most powerful thing in this video. And in a few minutes, I'm going to show you the level 3 play But first, here's why level 2 ruins more retirements than almost any other single decision point. There's a story that circulates in financial planning circles about a retired civil engineer named Frank. Frank spent about 6 months.
He'd factored in his family history, his health situation, his general sense of things. His father had died at 74, his grandfather at 71.
He concluded his break-even was somewhere around age 80, and that waiting felt statistically risky. So he claimed at 62. Seeing $19,940 a month felt like a win. Frank was the higher earner in his household. His wife Carol had worked part-time through most of their marriage, raising their kids, and her own Social Security benefit was around $700 a month. Frank figured they'd be fine. He hadn't, however, run the numbers on what Carol would receive if he died first. He just hadn't thought about it. Frank passed away at 78. Carol was 75. She lost her own benefit, stepped into Frank's survivor benefit, and spent the remaining years of her retirement on the amount Frank had locked in 16 years earlier. $1,940 a month. Not the full benefit he would have received at full retirement age. Not the maximum he'd have received at 70. The 62 amount, locked in by a decision her husband made when she was barely in her early 60s, and Medicare felt like a distant abstraction. The survivor benefit is one of the most consequential numbers in retirement planning. It is also one of the most consistently miscalculated, because here's the mechanic in plain language. If you die before your surviving spouse can step into your benefit level, but only what you were actually receiving at the time of your death. If you delayed to 70 and locked in the maximum, they receive the maximum for the rest of their life. If you claimed at 62 at a permanent 30% reduction, they receive the 30% reduced amount.
That's the number they manage healthcare costs on. That's the number they pay rent or property taxes on for potentially 2 decades.
The average American woman age 65 today is projected to live to approximately 87. The average man to about 83. That's a 4-year gap. And because men tend to be the higher earners in many households, and therefore tend to hold the more consequential claiming decision, the math here is pointed in a very specific direction. The lower earning spouse, who is statistically more likely to outlive the higher earner, often spends the longest and most expensive stretch of her retirement on whatever number her husband decided to lock in at 62. She's managing inflation, managing healthcare, managing the psychological reality of solo retirement on a structurally reduced income that was set. That's not a hypothetical. That's the lived situation of millions of people right now. Here's the number that really lands. If you're the higher earner and you delay from 62 to 70, your monthly benefit increases by approximately 7. That same percentage advantage applies directly to the survivor benefit your spouse receives after you're gone. On a base benefit of $2,000 at 62, that's a difference between $2,000 and $3,520 per month for your surviving spouse.
Over 10 years of survival at today's dollars without any cost of living adjustments at all. That's a gap of $182,000.
With cost of living adjustments, which are percentage-based and therefore compounding wider over time, the true gap is larger still. You think the problem is whether you'll live long enough to personally break even on delayed claiming. The actual problem is whether the person who will almost certainly outlive you has enough income for potentially 20 years of retirement after you're gone. This is where it gets really interesting. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. All right, level 3, the tax architecture. And this is where I want to introduce the concept that completely reframes the Social Security timing question. It's called the golden window. And if you've never heard of it before, you're about to understand why the people who know about it and act on it end up in a structurally different financial position than everyone else. Here is the setup. You retire, maybe at 62, maybe 63, 64. Your earned income drops to essentially zero.
You haven't started Social Security yet. You haven't hit the age where the IRS forces you to take required minimum distributions from your traditional IRA or 401k.
That threshold is currently 73 or 75 if you were born in 1960 or later. So for a period of several years, sometimes as many as 8 to 10 years, you find yourself in a genuinely unusual position. You have significant retirement savings, but your taxable income is very low. Nothing meaningful is coming in. Nothing is being forced out. Your tax bracket has collapsed. You might be in the 12% federal bracket, maybe 22% if you're drawing modest amounts for living expenses. But your effective rate is dramatically lower than it will be once Social Security starts. Once required minimum distributions kick in at 73, and once all of those income streams pile on top of each other in a bracket stacking scenario that the IRS was basically designed to exploit. The move you make during this window is called a Roth conversion. It is not a loophole. It's exactly what Congress intended when they created Roth accounts, a mechanism to let people pay ordinary income tax now. You pull money out of your traditional IRA or 401k, pay income tax on it at your current low bracket, and transfer it into a Roth IRA. Once it's there, it grows tax-free. No required minimum distributions, no tax on withdrawals, and under current rules, your heirs inherit it tax-free. You're not avoiding taxes. You're paying them early at a discount before the bracket window slams shut. Now here's why this interacts so precisely with Social Security timing and why claiming early destroys this opportunity.
The moment you claim Social Security at 62, you layer income on top of whatever you're drawing from retirement accounts.
Your taxable income rises. Your bracket rises. The golden window starts closing immediately. But it gets worse. There is a specific threshold, $25,000 of combined income for a single filer, $32,000 for a married couple filing jointly, beyond which Social Security benefits become taxable. Not slightly taxable. Up to 85% of your Social Security benefit can be subject to ordinary income tax. So, by stacking Social Security income on top of IRA withdrawals, you can find yourself paying taxes on 85% of a benefit.
The vending machine gave you the discounted item. The IRS then charged you for the discounted item.
You're getting squeezed from both directions simultaneously, and you only pressed one button. Here is the math. Let's say you have $900,000 in a traditional IRA at age 63. And you decide to delay Social Security until 70. You have a 7-year golden window. During those 7 years, you need roughly $45,000 to $50,000 per year to cover your living costs. You draw that from a taxable brokerage account first, then from modest IRA withdrawals. On top of that income, you convert an additional $60,000 to $80,000 per year from your traditional IRA into a Roth. Over 7 years, you've moved somewhere between $400,000 and $550,000 into the Roth. You've paid roughly 88% for tax. Not at the higher brackets you'd be paying in your 70s when Social Security, required minimum distributions, and investment income all stack up together. Your traditional IRA is now dramatically smaller. Your required minimum distributions at 73 will be calculated on a much smaller remaining balance. And your Social Security benefit at 70, somewhere around $3,400 to $3,500 a month, versus the roughly $2,000 now gotten at 6. So you're drawing less from the portfolio at the exact moment markets are most likely to punish forced withdrawals. Compare that to the person who claimed at 62 and skipped all of this. They saved $22,000 a year in Roth conversion taxes, and paid far more than that over a 20-year retirement in higher brackets, higher Medicare premiums, and higher forced distributions on a traditional IRA that never got downsized. They got the check, the government got the bracket. Now I want to introduce you to someone I've been watching make these decisions in real time, because this subplot matters, and I'm going to come back to it. His name is Marcus. Marcus is 58, runs a small manufacturing business, has $1,200,000 split between a 401k and a taxable brokerage account. And for about 2 years, he's been telling everyone he knows that he's going to retire at 62 and claim Social Security immediately. His reasoning? He doesn't trust the market to cover him for 8 uncompensated years. He wants guaranteed income in hand, and he figures certainty is worth the reduction. His reasoning is not irrational. He's applying it to the wrong problem. I'll tell you what happened when he finally ran the numbers. But first, there is a thing called IRMA that nobody mentions in Social Security conversations, and it's the most expensive thing most retirees have never heard of. IRMA stands for Income-Related Monthly Adjustment Amount. It is Medicare's mechanism for charging higher-income retirees more for their Part B and Part D premiums. In 2026, if your income in 2024 exceeded approximately $106,000 as a single filer, the income figure Medicare uses for this calculation includes Social Security benefits, IRA withdrawals, capital gains. And here is the wrinkle that really matters. Medicare uses a 2-year look-back. The income you report on your taxes in 2024 determines your premiums in 2026. The decisions you make today show up on your Medicare bill in 2 years. Many people have no idea this connection exists until the bill arrives. The annual surcharge can add $2,000 to $4,000 or more per person per year, depending on where your income lands. For a married couple, you can double that. And because the Medicare premium notice arrives as a line item on a statement and not as a letter explaining which income decision triggered it 3 years ago, most people never connect the surcharge to the Social Security timing choice that caused it. The vending machine gave you less. The IRS taxed it. And Medicare sent a separate invoice. That is 3 independent financial hits from one button press. I had a conversation once with an accountant, genuinely sharp guy. Completely. Not someone who gets rattled easily, and he was reviewing a situation where a client had claimed at 62 was drawing IRA distributions on top of social. He stared at the screen for a long time and then said, very quietly, they paid taxes on money they didn't need yet. To receive a smaller benefit they didn't need yet, so they could pay higher Medicare premiums they could have avoided. That's 3 bills for one decision. Then he closed the laptop. That's the system. I'm not angry about it. I find it somewhat impressive, architecturally speaking. It takes real craftsmanship to build a decision framework where the default, most instinctive choice is also the most expensive one. Speaking of most instinctive choices, here's a pattern interrupt before we go further. The Social Security Administration sent you a letter on your 62nd birthday or close to it, letting you know you're now eligible. It lists your benefit amount at 62. It does not list your benefit at 67 or 70 in the same prominent position. It does not include a column for your spouse's survivor benefit under various claiming scenarios. All of that information exists, it's just not in the letter. The letter is about what you're eligible for. It is not optimized for what you should do. Now let me give you a concrete scenario with real numbers. Because abstract strategy only goes so far. Imagine a married couple. Call them Ray and Diane. Ray is 62, Diane is 60. Ray was the higher earner through their careers. His full retirement age benefit, what he'd receive at 67, is $2,800 per month. If he claims at 62, that 30% permanent reduction brings him to $1,960 a month. If he waits until 70, his benefit grows by 24% beyond the full retirement age amount, landing at approximately $3. Ray and Diane have $900,000 in Ray's traditional IRA and $150,000 in a taxable brokerage account. In the first scenario, Ray claims at 62.
His benefit is $1 in 1960.
Diane claims at 67. Meanwhile, they're pulling from the IRA to supplement their lifestyle. Their income stacks. 85% of their Social Security becomes taxable. Required minimum distributions arrive at 73 on a still large traditional IRA, forcing taxable income even higher. They have no Roth cushion, no tax-free bucket, just a large traditional account getting taxed at an increasingly unfavorable rate as they get older. And when Ray dies at 78, which is close to the statistical average, Diane, who is 76 and may reasonably live another $19,960 per month, her own $900 benefit disappears. She's managing the rest of her retirement on the number RAY locked in 16 years earlier. In the second scenario, Ray retires at 62 but does not claim Social Security. He and Diane live off the taxable brokerage account. During those 7 years, Ray simultaneously executes Roth conversions of between $60,000 and $80,000 annually. His traditional IRA balance is down to approximately $450,000. Much smaller required minimum distributions ahead. His Social Security benefit at